Hi, welcome to the second video in our Engaging with Adverse Credit webinar in association with Pepper Money. Today, I'm joined by Adam Hinder, Managing Director at Simply Adverse, Rob Jupp, Group Chief Executive of Brightstar, Matthew Arena, Managing Director of Brilliant Solutions, Paul Adams, Sales Director at Pepper Money, and Nicola Firth, Chief Executive and Founder of Knowledge Bank. And I'm your host, Gary Adams from Mortgage Strategy. My first question is for Nicola. Do you think mainstream lenders are doing enough to alert these borrowers to how mortgage brokers may be able to help them? And if not, why not?
I would have to say no to that. I think that the biggest thing that mainstream lenders could do to assist would be to help signpost brokers, which opens the door then to the specialist market. If you think about the average customer, if they go to their own bank and try and get a mortgage and then they get declined, they're left with that knowledge. Even my own bank won't give me a mortgage. Now, we know in the industry that that's not the case. It's just that you don't fit their profile. You may bank with them, but that doesn't matter. You don't fit their profile, but there are plenty of the lenders that may lend to you. But a customer's reflection is my own bank won't lend to them. So where are they going from there? And I just think there's a lot more they can do to sort of see customers better informed at what their options are. And ironically, it's not doing the mainstream lenders any harm by doing that, because they're not turning business away. They didn't want that business anyway. So where is it going? And actually, the biggest irony being that these people might end up coming back to them as customers a lot quicker if we can get them into the specialist market and work on their credit profiles so that they can go back to mainstream when the time is right. So I do think there's a lot more that mainstream lenders could do with those kind of customers, definitely.
What could they do? How could the industry improve this situation?
I think we need to really pick up the value of independent advice. Nobody is beating the drum for it. Advisors, it's a fragmented community. We really are fragmented in a way we just can't get our message out to the masses. The promotion on the value of independent advice, wherever that leads, wherever that gets the prospective borrower to. We need to do more, and the bank should be working with us on that. Because Nicola's point there, this is how we grow the market. There are people out there who can get a mortgage and aren't aware of the fact that they can get a mortgage, or who could refinance and aren't aware that they could refinance. That's for sure. And that only grows the market for us, grows the market for the high street banks in the long term. And to me, that's all about increasing the value of independent advice, the perception of the value. We understand it within the industry, but those outside it, I don't think we're banging that drum enough.
No, I agree, and I think there's 3 points, or maybe 2 or 3 points I would make on this. Is that the first one is, clearly the likes of Pepper Money, we're doing as much as we can to not only educate, brokers and potentially my colleagues in other banks and mainstream lenders. I'm in regular dialogue with people in my position within those firms. But obviously through the adverse credit study that we do, we're trying to raise awareness, across the general public so that they're asking the right questions from the off and kind of head into the right direction to begin with. I think one of the important things in these types of scenarios is of course, the clock's already started to tick. Somebody's buying a house, they go to a mainstream lender, they can't help. It's not that the time stops and it kind of starts again when they find a new lender. A lot of the time, these customers are now panicking because time, they've lost 1 or 2 weeks already in getting a decline on the high street. And that's why, I suppose, from Pepper Money's point of view, and many of our competitors, work so hard on that service proposition, because we know that time is of the essence for a lot of these borrowers. So I think they do need to that referral or recommendation to seek professional advice after they've been declined in the high street is so important. And where there's a will, there's a way. The mainstream lenders should be able to do this. I know there's always going to be a concern around who we're recommending or are we recommending, because brokers are very different and have different business models, fee structures, etc. So there is some considerations they need to make. But I'm absolutely agree with Nicola. There's more that can be done to point borrowers in the right direction.
Sorry, just to jump in, I echo everything certainly Paul, Nicola and Matthew have said. For me, the banks have got to start at the very basics, the high street banks. If they're not giving someone a mortgage, fundamentally, they need to tell them why, first off. So it's very different. We don't accept your income. We don't value your income the same way as what another lender might. You failed the automated credit score, or you've got adverse recorded that has led to you failing the automated credit score. Because we often get people phone up every single day who says, my bank said no. So why is that? And they just don't know. Well, I think it's to do with my credit score. And then there's the whole education piece that we've done to death around credit score, credit profile, what it means, because that's where the education comes in.
I think there's also an element here. I don't know if you guys have experienced the same, but the staff working for high street banks are often really unaware of what is actually available beyond the high street. Their perception of what customers can get and can be obtained, it's not there. So if they're talking to somebody about it, that knowledge and awareness isn't there. So we need to have some kind of standardized response to really encourage any turn downs, any declines, armed with the reason, as Adam says, to get that independent advice.
Okay, great. Thanks. Really interesting. And my second question is going to Nicola as well, for reasons that will be clear in a moment, which is there a certain category of adverse credit that you think we'll see more of in the current environment and what's coming in the future? And is this different to what you've seen in previous months?
And that is a really good question, because of course on Knowledge Bank, every time a broker does a search, we're tracking in the background, and on an average month we've got anywhere between 12 to 15,000 different searches going through. So there's a lot of data to go at. And if you look back to the beginning of the year, out of the top 10, so just looking at residential, out of the top 10, we have 3 of those that were relating perhaps to adverse credit. If you move into June and what we're already seeing in July now, that's 5 out of 10. Now, if you think of all the categories, we've got almost 600 categories relating to property, self-employed, income, benefit, all the different things it could possibly be. But 5 out of the top 10 are around adverse credit. And what I will say, and I think we're going to see this because we've seen these creep in as well, so thinking about what we are going to see, defaults take 3 of those spots. So we have like defaults over £500, defaults that were registered either in the last 3 years or registered over 3 years ago. So it's interesting that defaults are definitely taking those top slots. So I think that's something that we'll see more of. Obviously, you've got the added complication of people coming off furlough, perhaps struggling to keep up with payments. It's interesting if you look at Pepper's own study. So, for example, in the last 3 years, the top reason for adverse credit was missing a credit payment, and that affected 9% of the population. The second most popular is a default caused by multiple missed payments. So you can see where that's going. So when missed payments are being searched for, the next thing that's coming is defaults. And in the Pepper study, that affected 2.1 million people, which is 4% of the population. So that's huge. I think just another interesting thing to pull out of the insights that we have as well is that soft footprint at dip stage has featured regularly now for the last 4 months in there. So again, this is brokers being really protective over their customers and their clients' footprints, that they don't want to do a hard footprint search because they're already coming to them with some sort of credit issues and something that may just tip them over if they do a hard footprint search. So I think that tells a story as well. But I think defaults are, I think they're here to stay this year in the searches.
Is this something that the brokers in the group today have, can corroborate?
Defaults clearly never gone away. I think probably last year and into the first couple of months of this year, there's been a little bit more social responsibility by providers not to enforce defaults, just because PR-wise it wouldn't be great during a global pandemic when people have got a bit more pressure. So I think sort of, as we enter the period of 19th of July, when we come out of this living hell, what you'll find is all of those ethics and morals probably go to the back of the queue, and the providers that are owed money just do what they've always done, which is they use the courts to try and get their money back, be it a county court judgment or a default of a credit. So I think you've had probably a disproportionate smaller number in the last 15 months. That's purely just down to companies being a bit more responsible, but expect that change very soon.
From my perspective, Gary, the defaults is still only part of the process and part of the understanding. So whilst we might want a lender that's sympathetic to the defaults, the next question that we'd have to be asking before we even think about lender is, well, why have the defaults happened? So that's typically life events, employment changes, self-employment issues. So the defaults, whilst that's important and critical, who's going to lend, the rest of the story and the rest of the unique situation is, in some cases, even more important.
I agree, and it doesn't surprise me, Nicola, that those findings that you've been aware findings, such as that on this call, and it is in line with the survey, because I think that the survey and the adverse credit study, the other thing that it talked about was really a divided nation, as in there's so many borrowers that were able to save money and improve their financial situation through the pandemic. However, many customers who already had adverse credit found the opposite. They might have, and more people as a percentage versus the general population that had a reduction in income and therefore possibly have had to go out and get second jobs or other complexities for lenders to consider and to underwrite. And there was certainly from that group of borrowers a reliance more on credit and increase their debt rather than shrinking their debt. And I think it's not a surprise that a few people have therefore slipped up.
I would agree with Paul. I'm glad you mentioned the split society here. The inequality is something to pay real attention to. Because when we look at the credit stats, the amount of savings has gone up over the last 18 months. But the reality is that it's a very split picture out there, and there are a large number of people who are increasing their credit at this moment in time and have done over lockdown. And we are certainly seeing already problems from people having payment holidays, and that's already kicked in. And we're also seeing more missed payments on unsecured. And it's not going away. Rob's right with the lenders, showing a bit of forbearance there, but that's going to change pretty quickly. So I think that this situation with furlough about to go, it's only going to get worse as well. So there's going to be a lot more that we as an intermediary community and as a specialist lender community as well are going to have to help brokers and borrowers with.
Thanks very much for that. Paul, speaking from the lender side of things, do you believe that underwriters are prepared for what's going to happen soon? And is there an increase in the variance of types of cases they're seeing? And if so, is this something they're preparing for as well?
I think it's a challenging time for underwriters in general, because I think the world is changing and it's important that everybody keeps up to speed and in pace with that change. I suspect from a lenders who follow a more automated process that can become more difficult, because they're reliant on a machine and more kind of automated ways of making decisions, and I think that potentially now can cause problems, and I think we've seen that through the pandemic, whereby some of the service levels have slowed down, and some of that I think has been created by lenders still having the appetite to lend but not being able to rely on the automated models, and therefore for people to make those decisions and potentially they've not been used to sort of taking those views of cases that they've needed to. So, and I think that's been part of the problem where we've seen some slowing down. However, I think every lender in this market is adaptable. From a specialist lender point of view, I suppose I would say underwriting is our bread and butter, because that's the reason why a customer and a broker would consider a lender like Pepper Money, because that's what we've become experts at. And since the start of this year, we've actually increased our underwriting specialist team headcount by 2/3. And so we've gone from 15 up to 25 people now in those roles that are there to liaise directly with the broker, understand the cases, and try to make and formulate, the right lending decision. And all of that takes time, hence having to, take on more people. A big part of the onboarding of those individuals is training, and we follow a process whereby it's rigorous, as you can imagine. They go through a process. They're well and truly tested before they are signed off and as fully competent. But it doesn't stop there, and I think that's the important thing to make. We'll never get it right every single time, and I wish I could sit here as a lender and say we never get it wrong. We will get it wrong sometimes, but we have ways in Pepper Money to spot the mistakes, try and correct them, and we do a lot of root cause analysis. So when we submit cases for decisions and those decisions are made and it goes through a process of auditing and the wrong decision's been made, or it might have been the right decision been made but with the wrong information, it finds its way back to a forum whereby we can wheedle out the members of the team that need further training or more education, and so that we're constantly in that cycle of trying to improve everybody's knowledge and ways in which they underwrite cases. And I think that's the bit that has held us in pretty good stead most of this year so far, thankfully, and long may it continue. Because, like I say, I'd be a liar if I said we got it right every time.
Is there anything brokers or anything more brokers can do to help you get it right more often?
First and foremost, it'd be talk to us if you're not sure, because we've got various ways and means in which a broker can speak to us. It can be a member of our sales team. Or it can be an underwriting specialist directly. They've all got a way of we've got a way of brokers reaching them and having a one-on-one conversation. So I think if you're unsure, check. But I think it's no different really to any lender. It's all about that. Give us all the facts up front. You don't hide anything, because that always ends up in a delay or more questions being asked than are required. And for any underwriter to make a decision, they need to base it on facts and evidence. And so I would say there's key decision-making data that any lender would need, particularly in the specialist market, and it's proof of income, it's bank statements, possibly ID. I'd like to see more cases arrive with us as a full mortgage application with those documents attached to it than we currently get. You'll be gobsmacked at the percentage of cases that we get that arrive with no documents, and then of course that just makes the process longer. And there's not much we can do with a case without documentation. So I would urge any broker to try and hold on to the full mortgage application until you've got the documents, and then submit it all at once to the lender. And I'm sure I'm talking on behalf of most of my colleagues in the other banks as well.
Rob, from a broker's point of view, what is it that lenders and their underwriters can do to help place these adverse credit cases?
Well, I think first and foremost, we should just acknowledge that the UK specialist lenders have done a really great job, creating their businesses and creating products for a market that is very underserviced. So, I mean, fantastic. Lenders like Pepper Money and others are doing a great job of work there. I think the education piece is sort of maybe a bit overused, but we say it all the time. There's probably never been more broker education out there at the moment. Probably the bigger issue still remains, though. It's a routine, and if you're not getting involved in specialist customers fairly frequently, it's fairly expectant for a broker to be sort of unaware about the necessary documents that are needed. And the problem comes when an application comes in with incomplete documents, as Paul said, because straight away there is a sense of suspicion of that case. What are they hiding? If there's things that come out that the lender isn't aware of, then that's a big problem. So it's a bit of a call to arms, I guess. It's a bit of a cheesy call to arms for specialist distributors like Matthew and mine and other businesses out there. We get involved with these sort of transactions every time, so we're really used to them. It's just a habit form because we might have 10 or 15 of these every single day, and then we can more actively achieve and get these cases offered and ultimately completed.
And we've got a few brokers here today, so is there anything anybody else would like to add to that?
We have to look and understand that these specialist cases are different. So many brokers write a huge proportion of high street deals, and this is a specialist sector. It's called that for a reason. And one of the things that Adam mentioned earlier on was, what was the reason for the default? How what's the story? How did we get to this position? And I think that for a lender like Paul's and others out there, for Pepper to make a real assessment on a case, they need to have a full picture. And that is just to reiterate what Rob has said and what Paul has said there. Often, the brokers that aren't used to transacting in specialists are just trying to push a process through. They need to think beyond that and across the broader picture. And Rob's spot on there, using specialist partners like Rob's business and ours at Brilliant it's a great way to make that process easier for you. One of the problems I think we've had is that in order to get the best out of this whole situation, actually having a dialogue with the lender and the underwriter with the full picture has been very difficult for both lender and broker to actually get that through in the last 18 months. It's a bit of a chicken and egg situation there. Trying to get hold of some businesses has been impossible. So I think, and that's not putting the blame at anybody's door. I think the mortgage industry has done incredibly well at managing this whole process. But and I know it's something that Pepper is particularly driven to maintain high standards of service. For me, service and communication is really key with this, so we can have the dialogue with the full picture about the cases, and that's how you get these cases through and find the best home for them.
We're finding now, actually, that's probably our challenge where we've been in lockdown, so where your sales representatives and your BDMs have all been so much more available. I think naturally that's where the relationship is, and some of the questions and queries related to sort of business being processed goes, because there's a trust there. And as you know, Pepper Money fairly recently have changed our business model, including a change to our telephony system. So we're trying to encourage brokers to, when they've got a query relating to their existing business being processed, they ring a number, dial the last 6 digits of the reference number, and it routes them directly through to that underwriting specialist who owns that case. And we're trying to preach that message, but it's really, really hard to actually change broker behavior. And that's not a negative, because everyone's got used to going where they go with their questions, because that's where they go for all of our competitors, especially the mainstream lenders, for that additional support. And we're trying to come away from that, but it's really difficult because people aren't used to it. But we'll keep trying and we'll keep pushing that message. So yeah, that's thanks, Matthew. That just reminded me or prompted me.
Sorry, if I can jump in, Gary, as well. I echo what the chaps say. For me, the one part is we're heading towards a summer like no other summer, on the back of the stamp duty deadline, people not really taking a holiday for the last 9 months adequately. And if ever, lenders historically, I think the specialist lenders have done brilliantly throughout this period. Even when things haven't been good, most of them have at least communicated it's not going to be good, and we understand why, and open the door for sort of specific dialogue. But how they manage the summer is going to be critical. And also how we manage this period coming out where, let's be honest, self-employed is a large part of all of our businesses, including Pepper Money's. And there's a relative amount of scheme abuse that has happened over the last 9 months, where furloughs, retention, bounce back loans, and we're coming to a period now where the businesses are going to have to start paying those back. And I'm assuming there's going to be an element of default on that, and therefore people's employment and self-employment history is going to change. And I'd love us as an industry to be on the front foot and understand how lenders are going to treat people who have changed from self-employed to employed, from self-employed in one business starting up another business. So in 3 months, when we're in the busy summer or just outside, we're not going to be saying that could have been helpful up front. And the same with people changing sector, because there is still a little bit of volatility with the lenders around sector of employment. So if somebody dips out of one but only recently starts in something that's deemed more secure, or more importantly, what is deemed as secure? What's a secure industry? What's a secure employment or self? And that's where the engagement with the lender comes in, because every lender's sensitivity over this is completely different. And we're rolling as we get them rather than thinking about it in advance at a time where resourcing is probably going to be an all-time low for everybody in the next 2 months.
My final question is quite broad. I'd like to ask Matthew, but I'd be really interested in seeing what everybody else has to say about this as well. One thing, the Pepper research has been alluded to previously when I was reading it over the weekend. I noticed that the main place people find a mortgage broker for specialist lending and adverse credit is online. And as much as, the internet's become such a huge part of our life, I think it's easy to forget there's a lot of people who don't have access to a computer or they don't have the skills. And we've seen this with shops refusing to take cash over the last 15 months or so. Is there a danger that somebody who could really use a specialist lender is simply not even going to be aware that they exist, or if they do, they don't know how to access them without the internet? And if so, is this something that can even be solved?
When I look at this, and I look at people being left behind, I don't really see the internet as being a negative tool. I think I see it as an additional route for people to be able to find an advisor. The fact that more people find an advisor through the internet doesn't mean that there aren't the old channels available. And certainly for people who are of a different generation, or perhaps aren't online in that sense, they will still be aware of the availability of intermediaries. So I don't think there's going to be a disenfranchised community out there from the web perspective. And you touched upon something there, Gary, that really I think is the big issue with that. And personally, I think the people that are getting left behind are those who aren't aware of the specialist advice products that are out there for them and their needs, which we touched upon earlier. And I think those are the people who are being left behind. And in terms of numbers, I think those are going to be significant. I'm not saying there won't be people that are affected by the move to the internet and the move online. There will be, but I think the far greater volumes will be the people who just are not aware. They've been to their bank, they've been declined, they've spoken to others, they've been told there's no chance, whether that's self-employed people that Adam was talking about earlier on, or whether it's adverse. I think we need to raise that awareness so that we don't have problems of inclusion purely from a perception basis rather than an accessibility point of view, Gary.
That's a good point. I think that the message is really clear here. If you're a client who believes they require a specialist mortgage, go to a mortgage intermediary. Don't go to your bank, because you'll waste your time. Go to a mortgage intermediary who control the entirety of this market. And I've said numerous times, this is possibly the only market out there in the mortgage world which is entirely sustainable. Right, as soon as you get customers, you support customers, they will know other people in similar situations that possibly don't have the confidence to put their head up and say, well, actually, we want home ownership and we thought we couldn't. So this is really sustainable. It's owned completely by UK mortgage intermediaries, and post the end of stamp duty, this will be a fantastic, rich seam of business for any intermediary who's bright enough to get involved in it.
Great, thanks very much. Nicola, what's your take on this?
Well, I would agree with everything that Matthew and Rob have just said. I think the other thing is not to forget just how important referrals and recommendations are. And I think the specialist market is fantastic for that, because if you deal with the client and everything sails through, it's not very memorable. But in the specialist market, it tends to bump around the sides, and that's where the real value of a broker comes in. And that client is so grateful for what you've done, and they'll talk to the people about it as well. So I think the specialist market, yes, online it is really important to have an online presence, because, as you quite rightly say, that's where people go to look and find a broker. But we can't underestimate the power of recommendation from peers and friends. And I just think that's massive. So I think that's never going to go away, because if you've had good service, you will talk to the people about it. And if so, can you recommend somebody? Of course, you're going to go back to your last experience. And if that's a good one, you've had good customer service and a broker's really gone out of their way to place that case and help you, then you're absolutely going to recommend that person.